Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you're enjoying the show, do me one quick favor and leave us that rating and review. And if you haven't already, be sure to hit that subscribe button so you don't miss an episode. Now, today we're going to be talking to Sarry Ibrahim. Sarry Ibrahim is a financial specialist, private money lender, real estate investor, and member of the Bank on Yourself organization. Let me read that intro one more time. Sarry Ibrahim is a financial specialist, private money lender, real estate investor, and member of the Bank on Yourself organization. Now, he helps business owners, real estate investors, and full-time employees grow safe and predictable wealth, regardless of market conditions, using a financial strategy that has been around for over 160 years. Let's welcome to the show, Sarry Ibrahim.
Hey, John, thank you so much for having me on. It's nice to talk to you and talk to your audience.
Absolutely. Listen, it's a pleasure having you on today. I went over your bio at a very, very high level. Take 2 minutes and fill in some of those gaps.
Yeah, definitely. So like a lot of other financial professionals, I didn't necessarily grow up wanting this specific job that I'm doing today. It was kind of a combination of different things I've done in the past that kind of led me to this specific niche that I'm doing right now. So I guess this journey really started off when I was a senior in high school. I took one course. It was called Consumer Economics. At that time, we were all required to take that course. And it was pretty much how to write a check. What is a checking account? What is a savings account? What is a mortgage? And I love that class because I think it's so important. I think it's far more relevant than like humanities and like art history is. But that's just my opinion. You know, I think we should take more courses like that at a younger age to learn about money and how money works. So I think that course really kind of shaped me for the rest of my life. I wanted to do something that helped people with money, helped kind of financial struggles, seeking financial opportunities. But again, in that world, there's thousands of jobs and career paths that fall into that area, right? It's not just one job called finance and that's it. So there's many different ways. So I got my MBA hoping that it would shed some light and kind of guide me in a better direction. It sort of did. I wanted to be a project manager, but really kind of drew me into the insurance and financial services sector. So I worked for Allstate was my first professional job that I worked at. And then that kind of opened my eyes to helping people solve problems. It wasn't more so of insurance. It was more so of solving financial problems, budgeting. And I noticed, John, that people started to become comfortable talking to me about money, talking to me about some of their financial struggles. And I kind of found myself in a situation where, you know, we were helping them uncover different things. And I wanted to sharpen these skills, kind of go further into this area of financial counseling, financial coaching. So I started to read a lot of books and I went to Amazon and I searched for books on finance. Of course, Rich Dad, Poor Dad, so many finance books that I read. And one of them was The Bank on Yourself Revolution by Pamela Yellen. So Pamela Yellen wrote this book called The Bank on Yourself Revolution that talks about this concept that we could jump into. But long story, I know that was a really long answer, but that's how I got into what I'm doing today and Bank on Yourself.
Yeah, you talked about, really starting off almost in high school, right? You had that kind of class, that transition class. I forget what they call it now, right? It's like a kind of econ, but not really, but they kind of teach you the little basics. And it's funny. I remember some of those classes too, right? My dad taught me to balance a checkbook when I was like 13, I think. Oh. So it's like a skill we've never really used, but I mean, it's good to know how to manage your money, but not necessarily the checkbook anymore. Nonetheless, that really was your introduction to this space to learn more about finances, studied that in school, went and worked with Allstate and working with other individuals and helping them in the insurance as well as their personal finances. And that kind of led you down this path to learn more about the Bank on Yourself as you started reading more and more books. Let's talk about that, right? So when we think about, the Bank on Yourself concept, first and foremost, just explain exactly what that is and who does this apply to?
Yeah, good question. So I guess to start off by explaining like what Bank on Yourself is, it would probably help to start off with some common financial problems out there. So just a few financial problems, I guess, going back 20 years ago, we have market volatility, right? Like we would look back at like 2008, 2009. And as we're approaching now, 2022, people are saying there's this new recession. So I guess that's one problem in business and in finance, right? Is market volatility, things outside of our control. We have no control over. Second problem, taxes, right? It's like as we make more money, we pay more in taxes. And we're taxed in so many different ways. So I guess taxes are a big part of entrepreneurship and business. It's a big thing to consider. Third, we consider lending, right? Like how the lending criteria. If you really think about it, John, banks really control everything about money, about who can get money and when. Even if your credit is really good, even if your income is really good, banks ultimately have the control over who gets financed. So there's this whole a constraint over lending and the control over that. So just those three, there's more problems, but just to kind of keep it basic, let's just look at taxes, market volatility, and the ability to get money or raise money or borrow money. So how can we solve those three things with one vehicle? One way we could do that, there's the bank on yourself concept, which is outlined in the Bank on Yourself Revolution book. But to go a little bit deeper into it, it involves the use of a specially designed dividend paying whole life insurance policy that allows you to save on taxes in the future. It allows you to reduce market volatility, and it allows you to become your own source of financing, controlling your own terms when you lend. So I know there's a lot of big words, technical words, but in basic terms, we're using a specially designed cash value whole life policy to do those three things: mitigate taxes, mitigate market volatility, and become our own sources of financing.
Yeah, it's interesting, right? Because we've talked to a couple of people who play in the space of these whole life policies, and I pick up something new every time we have these conversations. So I hope our listeners are really understanding this concept more, because it does take a while to process, right? Yes. I mean, you don't really hear about this in school. You know, when you're learning about personal finances, people tell you about investing in stocks and maybe real estate, but they tell you to get a life insurance policy, but they don't really talk to you about how to use this concept. So let's just play that back. You know, let's take a step back. I want you to break that down one more time, because you talked about being able to solve these three problems, which are pretty common. And one of the biggest challenges everyone faces: market volatility. What should I do if the stock market goes down, or the economy's not where it was, 6 months ago, and I lose some value in my portfolio? What to do about taxes, right? That tax strategy is really key. And then the third is, I call it access to capital, right? And if you are an entrepreneur, or you're a minority, you have other situations where maybe you don't have the same level of access, or you're concerned about that access to capital. I mean, how many entrepreneurs are out there, and banks love you when you got a full-time job and a great W-2, but you want to go launch this business or whatever. And now, or you've launched that business, you're 2 years into it, and now you don't have that beautiful W-2 to show them. Well, now that access to capital may dry up. So I think those are really strong and real important challenges that many investors face. So let's break this down a little bit more. Please explain exactly, what some of these benefits are and how it works to address those three critical elements.
Yeah. Perfect. So like in a very simple way, we have a whole life policy, right? And it's a little bit different from what other people, like, for example, Dave Ramsey, Susie Orman, how they think about whole life insurance. They look at it as if it's just death insurance, and just for life insurance purposes only. And you should get the most economical policy, which is a term life policy where it's just life insurance only, and then invest the rest into the stock market or mutual funds. And let's put that on the side. But this is more so of not necessarily just purchasing a whole life policy. It's more of using it as a weapon against those three things: the market risk, the taxes, and being able to access your own financing. So when you have a whole life policy, there's two aspects to it. There's the cash value aspect, and there's the life insurance. A lot of people don't even know there's a cash value portion inside of a life insurance policy. They just think of it as just life insurance. So it actually, if it's properly designed, it has two parts: cash value and life insurance. And then both of those, again, if it's properly structured, both of those grow every year with interest and dividends. Dividends are not guaranteed, but we only work with insurance companies who have a proven track record of paying out dividends for well over 100 years, even through the Great Depression. So this company, for example, it's a mutual life insurance company. They have cash value and life insurance in the policy, whole life policy. The cash value builds up, it earns interest and dividends. And as over time, you have the ability to leverage that cash value. You borrow against it. Very similar to real estate. Imagine, John, you have a single family property house, right? Let's just say the market value is $500,000 on it. Let's just say it's paid off in cash. There's no lien against it. There's no debt against it. Now, let's just say I go to the bank and I want to borrow $100,000 against this property. When I go take out that loan, it does absolutely nothing to the market value, right? The market value is still $500,000, assuming at that time, that's what the market value was. In other words, the loan against it does not alter the value of the property, which what makes real estate a very good investment, is that you can leverage it, borrow against it. Very similar in the situation with whole life policy. Let's just say I have $100,000 in cash value in the policy, and I go take out a loan against it. It does nothing to the growth of the policy. It keeps growing even with this outstanding loan against it. So we get to borrow money and still have the funds grow. We get guaranteed access to interest. We get a high degree of certainty of dividends being paid out regardless of market conditions, even though it's not guaranteed. We get tax-free wealth. So the money that grows in the policy, if it's properly structured, grows tax-free. The loans are tax-free. The withdrawals are tax-free. The life insurance is tax-free. So you get tax-free all around, assuming that you funded the policy with after-tax dollars, very similar to how a Roth IRA works. So that's kind of how it's really like the intricate parts are working in the background.
I love it, man. So you talked about really being able to tap into the cash value of this insurance policy. Mm-hmm. First of all, whole life policy, there's a cash value side and an insurance side. You can tap into the cash value side. You can take loans against it. That value still continues to grow. You can pay interest. All this is really tax-free. Obviously, there's more nuances to this, and I implore you to learn more if this is a strategy you want to explore for yourself. And this is certainly not financial advice, but just telling you different strategies that are out there. But with that in mind, this is one of those things that even as an investor, someone who's hosted, many episodes and talked to a lot of other investors, this is still a relatively new concept for many people. Why don't more people know about this?
Yeah, I love that question. I think it's because of the way we, back to high school, the way we were raised, right? We were taught invest in the stock market, invest in mutual funds. Recently, investing in real estate has become more popular, more trendy. But overall, it's investing in the stock market, investing in mutual funds, trusting your local bank, keeping things, staying debt-free, not taking any risks. That's kind of how we've been programmed. So when we come across this strategy here with whole life insurance and borrowing and becoming your own banker, it's kind of way outside of our, paradigm. It's way outside of our conventional thinking. And of course, if, conventional thinking, it takes us further into these problems, right? Paying cash for things, investing in the stock market, investing in mutual funds, relying on banks always to lend you. These are having one job. These are all conventional things that can actually put you into a further financial mess.
Yeah, it's interesting too, because I think about a life insurance policy, and the challenge for most people is well, I have to die for someone to benefit, right? Yeah. I don't like those kind of investments. Yeah. Any investment that includes me dying is not a good investment, right? Yeah. I mean, it might be great for my family, in the long haul, but I'm sure they don't want me dead in order to take this benefit. So I do like the fact that here you've got an asset that you can actually tap into while you're still breathing, as opposed to building up this policy and, until you croak, no one else gets any value. So that's really good to hear. Yep. I know you mentioned, that this is something that has to be structured correctly. And most people, probably have whoever their insurance person is, whether it's a big company like a Northwestern Mutual or someone like that. Are these policies available through those types of entities, or do you really need kind of a special entity or a special firm that offers these specialized programs?
Yeah, so they could, right? These large life insurance companies could. I guess some of the qualities to look for, the ways to design the policy is, number one, it's from a mutual life insurance company. So there's a difference between mutual and stock owned, right? So mutual, typically the policy owners are the owners of the company, very similar to how a credit union works. So you want to have a mutually owned policy, so that way you can get dividends back into your pocket, assuming it is a company that pays out dividends back to the policy owners. So mutually owned and pays dividends, you want that. Next is you want to make sure that the company is non-direct recognition. So non-direct recognition means that if you go back to our example, how when you borrowed money from the policy, in a non-direct recognition company, the insurance company will keep paying out interest and dividends as if you hadn't taken out that loan. In other words, whether you have an outstanding loan against the policy or not, you still get interest and dividends on your policy. With a direct recognition company, it changed the loan, the interest and the dividends you receive change according to the loan you have. A lot of the bigger companies, they don't really like when people take out policy loans. So they kind of, in a way, penalize the policy owners for taking out those loans, which then the way that policy owners could then counter that is they go get third-party loans from banks leveraging their life policies as collateral. And that's a whole separate strategy in itself. But I just like when the actual life insurance company itself has non-direct recognition, they will keep paying interest and dividends even when you have an outstanding loan. And then the third one is you want to make sure there's a paid up additions rider, and the paid up additions rider is flexible. So not every company is going to have the paid up additions rider. This is how you can enhance the cash value over time, turbocharge it, really grow that cash value. So that way, like you said, this is not so much of you have to die to win. This is more of while you're living, right? To amplify your current real estate investments or your current private money lending business or whatever you're doing, whatever type of business you're doing, to amplify those returns and to protect your wealth. This is kind of the objective of it. It's more of function over title, right? The title of it is dividend paying whole life insurance, but that's not really important. It's important what it could do and how it can help you is far more important than just the title of it. So we want to make sure there's a paid up additions rider that helps you enhance the cash value. And then of course, you want to make sure it's whole life. So some people out here, they could do this with index universal life. One big problem I have with index universal life is just the fee structure of how the cost of it increases over time. And I think that's going to affect the cash value growth you have in it. Whereas whole life typically is most expensive in the first few years, the fees go down over time. Eventually, your cash value ends up beating what you put into it. It exceeds what you put into it. Whereas index universal life can actually have an inverse effect where the cost of the insurance increases over time to the point where it's decreasing your cash value. So just stick to whole life, paid up additions, mutually owned life insurance company, and non-direct recognition.
All right, man. Great tips there. I love the recap. You already hit it, but I'm just going to play it back again. You said make sure that it's mutual. You want to look for a mutual policy, non-direct recognition. The third thing you're looking for is paid up additions rider. And then 4, making sure that it is a whole life policy. So great insights right there. If you want to be able to employ and take advantage of some of these different strategies for your own investing needs. You started talking about, index universal and, I know there's term, there's whole life. I mean, this can be really overwhelming for someone who is not in this space. I mean, most people probably think about life insurance, when they have big life events, right? When you get married, when you have kids, you might need to go update some paperwork, but most people don't sit here and just study life insurance, right? It's not like real estate or stocks where you're kind of actively learning about the market and what's changing and making sure you adjust your strategy. I mean, this is kind of a, set it and forget it type of thing. But it doesn't have to be. So when we think about term and whole life and, you said index universal, I might be saying that backwards. But when you think about all of those different things, where does someone start? And I think that the other question is really at what point does this make sense? Do you need to be a millionaire to take advantage of this? Do you need to have a policy worth $1 million, $500,000? Like, at what point does this become a smart move for a typical investor?
Yeah. So I would start first by just like listening to podcasts like this, right? Check out this podcast, check out other podcasts like ours, Thinking Like a Bank podcast. Or if you like to read, there's a couple books out there, the Bank on Yourself Revolution book by Pamela Yellen, Becoming Your Own Banker by Nelson Nash. These just kind of, I guess, get introduced to the concept, like understand that it does exist, understand there is a way to save on taxes, decrease market volatility, become your own source of financing where you're controlling the terms and conditions of the lending. So kind of just understand the basics of that. And then if you're ready, reach out for like a free consultation. You can always reach out to us. I'm sure you'll include the link in the show notes below, but you could always reach out to us for a free consultation, just a free 15-minute call, or if you have any questions. But I would say the biggest thing is about this, it's education, right? It's very foreign to a lot of people, right? This whole idea. So kind of get familiar with it. It does work. It does help. There are thousands of people who do this. Large companies do this. Banks do this. So it's not something kind of like, a secret. It's a lot of people are doing this. If you go to almost every real estate podcast out there that I've listened to, at least has an episode on infinite banking or the bank on yourself concept. So this is working. I'll learn about it. And of course, you can always reach out to us for a free consultation. We can go through some of the stuff. And then maybe even talk to like a few advisors, talk to your accountant too. There's a lot of tax parts that goes into this, especially if you're a real estate investor. So talk to your CPA about the strategy, talk to your attorney too. There's a lot of asset protection that goes into this about protecting your wealth from creditors and things like that. So check with your attorney about how this plays into your estate plan and your asset protection plan.
Yeah, great question or great response there. I want to push just a little bit because I know there are people who are maybe excited about this and don't want to spend 10 hours researching and having these conversations just to realize it doesn't really apply for them.
Yeah.
Is there really a minimum threshold that you say, hey, you really want to at least build this much into the policy or policy of at least X amount of dollars? I imagine there's some cost benefit analysis that at a certain point it makes sense. And, at a certain number, maybe it doesn't make sense. But do you have a general rule of thumb or a minimum number to at least consider looking into this more?
Absolutely. Yeah, definitely. So I started my first policy with $300 a month. So I would say if you have just about $300 a month of just extra income, I strongly encourage you to utilize the strategy, or at least look into the strategy, because of what it could do for you in the future. I would say, John, that 100% of people, 100% of people I talk to that are in their 50s and 60s say the same thing. They say, I wish I did this when I was like 25 years old. I'd have like $1 million in this tax-free or whatever. So I'm talking to those people. If you have a few $100s, do it now, save up in it. And again, this does not replace other investments. So you might be on the fence. Should I invest in real estate passively, or should I do this, or should I go to stocks? I think you could do all those things at the same time. You could save into this, leverage this, invest into real estate, use some, other types of strategies to invest in different places. So I guess open your mind, expand your mind, and definitely check out, just a few $100s. You don't need to be a multimillionaire to use this strategy. You could do it just a few $100s a month, like I did mine. And then of course, you can add on more policies. So it's very common for people in the space to have like 20 policies or more over time, of course, and then they can use their investments to fund their new policies, and then use those policies to fund new investments. And then it has this compounding effect where you have your own banking system that could fund these investments on your own terms, recouping that interest you would otherwise pay to other lenders back into your pocket. Again, amplifying your other investments.
I love it. Great insights right there. Last question on this. When we think about those folks, maybe already have policies, whether you have a term policy, maybe you already have a whole life policy. Is there a way to convert an existing whole life policy so that it can be this bank on yourself concept? Or do you really need to start with a brand new policy to be able to tap into these advantages?
Yeah, perfect question. So you can actually, there's a lot of stuff you could do. So let's just say, for example, somebody does have a whole life policy with another company. There's some cash value, but again, it's not mutually owned. It's non-direct. It is a direct recognition company, and then you want to kind of merge into the bank on yourself concept. Yeah, we can do something called a 1035 exchange, very similar to real estate, like a 1031 exchange, except we're rolling the cash value and the cost basis of one policy into another policy. It's a tax efficient move to do that, and you could amplify your new policy. You could ignite it, start your new policy already with the kickstart because of the funds you put in the past. So you can go from whole life to another whole life. You can go from term to whole life. If the term life policy you have is with one of our participating companies that use the bank on yourself concept, you could convert the term policy. Let's just say $1 million term policy. You can convert that into $1 million whole life policy without any underwriting. You would just do a new application for that. That saves a lot of people who can't get life insurance now due to some medical condition. And then you can even do the same thing with index universal life. You can roll over the cost basis and the cash value from one policy into a new whole life policy. So again, we always do like a financial analysis with clients. That's the most important part of the relationship. We do like a full 1 hour financial analysis. We go through the real estate. We go through our other investments, mutual funds, annuities, life insurance, long-term care, disability insurance. We go through all of that stuff to see how we can best fund the new policy, or what way and how much and for how long, and all those other factors.
I love it. And listen, the whole point of this conversation is, we are all searching for kind of the same thing, right? We're looking for financial freedom, financial stability. We are looking to protect our assets for the future, generational wealth. And this is just another tool in the tool belt. We love multifamily investing. And part of what we want to do is figure out, how do you free up more capital to buy more real estate, but also how do you set yourself up from an asset protection standpoint, so that your heirs, your family, they're well positioned moving forward. And this is just another tool in the tool belt, another thing to consider, strategy to look into. And if you liked what you heard from Sarry, I advise you to check out his website and check out the podcast. You can check out his website at thinkinglikeabank.com and learn more about what they're doing right there. Sarry, we're going to move on to our round of insights. Ready?
Yes.
All right. Give me a failure or an apparent failure that set you up for later success.
Yeah. I guess I thought this was a failure. When I graduated college, I applied for a big company for their business development division, and I didn't get the job. And I thought that was a failure. And it was just, it was a way to look for a different path. And I think that, because of that failure, I found this path now. So yeah, it's I actually like talking about failure a lot, because I think that it's just, for every door that's closed, another door opens. It's a way of telling you, like, try it again or try a different place, and to find those, what might seem to be a random surprise or a lucky event really just was derived from failure.
Just real quick tidbit. I was at an event 2 weeks ago, And I heard a woman say something really interesting. She said, I failed a lot. She wanted to be an actress. She wanted to be a singer. She could not sing. They used to cut off her mic. But what she learned going through that process was that she could talk while doing things. You know, she could kind of learn to speak from her diaphragm and down low. And she actually started growing her business as a YouTube workout person. So because she developed these skills from singing, even though she couldn't actually sing, she developed the skill to be able to talk and work out and do things at the same time. And her message was, sometimes you're developing skills and you have no idea what they're for. And that doesn't necessarily come to light until much later in life. So don't look at it as a failure. Continue to, embrace those experiences and embrace the experiences you have and lessons you're learning. And at some point that will materialize of why you went through that cycle. So great point there that you made about failure. I really appreciate that. All right, back to the round of insights here. All right, give me a digital or mobile resource you recommend for your business.
Digital or mobile resource. I would say my CRM, but it's probably generic. I guess, without my CRM,
do you use?
It's called Radius. It's just a way to keep track of, clients, keep track of what they're seeing, in the financial analysis meetings. I have to actually retain that information, attach documents. So there's probably more out there. I just can't think of anything right now. I would say, when it comes to technology and business, I think CRM is the first thing that comes to mind.
Give me the book you've recommended or gifted the most in the last year.
Becoming Your Own Banker by Nelson Nash. And it really highlights everything we've talked about in this episode with structuring policies and things like that, and why even do that in the first place. So yeah, Becoming Your Own Banker by Nelson Nash.
What's a daily habit that helps you stay focused on your goals?
Recapping my priorities every morning. So every morning I outline, like, for example, the top of my list is my business, and then the top tasks I have to do for that business. And I do this every morning. The first thing that I do is because if different opportunities come my way throughout that day, that'll take me away from my current business or current projects. I have a way to deter that. I already said no before those other opportunities came my way, just to keep me focused. Because this is one problem I think a lot of entrepreneurs have, including myself, is, chasing that shiny object syndrome, looking for different opportunities, different things that could potentially take you away from your business. So I try to say no before those opportunities even come my way.
Give me your number one insight for investing. And I'm going to say in this case, investing, leveraging kind of this banking on yourself concept.
So the best, you said strategy?
Your number one insight for investing, particularly using this bank on yourself concept.
Yeah, definitely. So number one insight using this policy, I would say align it with your objective, right? So before you come across the investment opportunity, write down your objective. What is it that you want to do? Again, it's irrelevant from the strategy that you're coming across, and then find the strategy that can align with your objective. And a lot of people have it flipped the other way. They want the investment strategy to be consistent with their objective, but rather flip it, have something else be consistent with your objective, because that keeps you, that increases the chances of you choosing the right investment, because some investments provide cash flow, some of them provide capital appreciation, some of them provide a combination of both. But when you have your objective outlined already, you can find that strategy that best fits your objective.
There we go. Sarry, where do you live?
I live in Chicago, Illinois.
All right. So you're in Chicago, great city, one of our favorite places to be. Give me your number one place, or your favorite place, I should say, to grab a bite to eat.
Okay. You have to have deep dish pizza in Chicago. It's a must, for sure. I mean, there's so many places downtown Chicago. I think just one that comes to my mind right now, Pizzeria Uno. It's like the best deep dish place in Chicago.
According to you, or according to who?
I don't know. I think a lot of people say that. I think that it's up there. For me, it's top 5 for sure in Chicago. And for a lot of Chicagoans, that's probably the first place they can think of, just because it's in the center of downtown Chicago too. So
I passed it many, many times, man. So I get it. Yeah. I'm personally a Illuminati's fan myself, but I like Uno as well. Excellent. Well, listen, great tips there. Great food places. We know that. I get to Chicago often, so we'll have to make sure we maybe grab a bite there next time I'm in town. But I really appreciate our conversation today. As I mentioned, we've had a few conversations on infinite banking, or this banking on yourself concept. And I really appreciate the way you were able to break down how this helps the average investor, really addressing 3 things: market volatility, taxes, and access to capital. So those are things that you are concerned about. It may be worth learning a little bit more about this concept to see if it can work for you. If you want to reach out to Sarry and learn more about him, you can go to thinkinglikeabank.com.
Yes.
And we'll be sure to put that in the show notes. Sarry, just want to thank you again for coming on the show, being a great guest, and we look forward to staying in touch and growing from there.
Thanks, John. Thank you.